Lots to unpack in our high yield portfolio update, so we'll get right to it. With all of our quarterly updates, the spreadsheet is linked in the show notes, as well as our video where you can watch us walk through the data. Tim bolds the overvalued stocks that he wouldn't buy or drip, and gives you a buy up to price to ensure good yields. If you're just listening to the audio, focus on the monthly totals compared to last quarter and our discussion on each stock. The thought process is what's important for you to make informed investing decisions. This portfolio is positioned to make about 22% in dividend income for the year, which is double the yield of the conservative portfolio. So now let's break it down. All right, so last week we talked about... Last week we talked about the conservative portfolio.
This is part duh.
And this week we're going to do the high yield, which...
Just going to do the van one. The van one.
Everybody's excited to see what the heck we're making from our itty bitty portfolio. Now, I will say when Tim did the numbers for this, our portfolio was how much in value?
99-ish around there.
So just under 100,000. And it was at 110 and it's dropped. I think it's hit a low of 96 during all these market.
Yeah, we made it all spot. We almost got it to 111 before the overlords' policies have caused everything to go to chaos. So
I'm assuming your current price column is going to be...
Column E there is going to be different, obviously.
Our current price column here is...
It's going to be a little bit different, but this column D is just the same. So just buy up to. A lot of stuff's going to be available to be bought because of the current prices being so low.
Yeah, so that'll be nice.
But just knowing that I did this on 3/1, so these are prices as of March 1st.
2 weeks behind
March 1st.
You should have been looking at these closer to the date.
Fuck that.
Well, this is why we should have recorded sooner. But anyway, sorry. That's one of the things that sucks about the investing realm is stuff changes so freaking much, so fast.
Changes daily, so you just got to take a moment in time and say, here's my moment in time.
So basically pay attention to the buy up to price, and then you'll just have to check the current price for yourself.
So the C column is going to be different.
Your yields?
Because the E column is different, but it is what it is.
Yeah, so your yield is based on current price.
You get the general idea.
Yeah, okay.
Like a lot of these fuckers yield a lot.
So without further ado, you will see that our portfolio is like half of what my mom's retirement portfolio is with that more conservative approach, and we're making a lot in divvies.
Again, these totals don't include like $400 for ABR, Hercules Capital, and UAN. We discussed that last week because they do that crazy wonky crap where they just...
So for whatever reason, February's should be payout happens first week of March type deal, so some of the numbers are off, which is why February is a low month.
Okay, and then the last time we did this, we made $17.61 in the month of September, $15.85 in the month of October, and $2,022 in the month of November.
Which is very nice.
So the total for the quarter was $5,368. Now, I can tell you the one in November was high because there should have been some December dividends taken out of that, but it is what it is.
November was high?
In November it was a little bit high. November should have been like 1,800 or 1,900, so it was a little bit high.
So they paid in November instead of December?
Yeah.
That's really weird.
There's some weird shit going on with the dividends, but it is what it is. Like
very odd.
We'll just make do with the data we have. We did have a lot of shit going on in our portfolio this past quarter. We sold AFCG. The AFCG is a weed mortgage REIT.
Really? A weed mortgage REIT?
And because cannabis isn't going to be as forefront in the policy of the conservatives that hold the power and everything, AFCG is kind of in a bad spot, and it's going to just go down. So I got out of that pretty much right after it was determined that it was no longer an important policy principle. So I got out of that one. I forget the exact date I sold. It might have been January something. I don't know. BITO I got out of because that was all profit. I should have let it run, but I wanted to try a new experiment with the IBIT, which is they hold Bitcoin and they just trade on Bitcoin. And then I wanted to, so I put half my BITO money into IBIT and half my BITO money into YBTC. YBTC trades IBIT options and IBIT trades Bitcoin. So I'm seeing which one does better. And whenever I'm going to probably do it for 6 or 7 months
it's a little confusing, but
I'm going to, whatever one's doing better, I'm going to sell the other one and put all the money into the one that's doing better.
But they're all plays on Bitcoin, and Tim's just trying to figure out the best way to get yield and payouts and principal retention, I assume?
If I had to guess right now, because IBIT doesn't have a dividend and YBTC does, I'm probably going to sell IBIT and put it into YBTC, but we'll see.
Yeah, I don't even know why you picked IBIT, but okay.
Because it's directly into Bitcoin.
Which is down and being suppressed.
But whereas YBTC trades on the IBIT, so I wanted to see because I wanted to see if the options on IBIT did better than actual just holding Bitcoin. That's what that was.
Oh, okay. You do you with your experiment.
It was experiment. The next one we sold was EPR. EPR is a REIT that is it's a really good REIT, but it got too high in price for me, so I just got out of it. And I was only making like $20 a month from it, so it really wasn't worth holding on to. I could make more with that capital and something else. We got out of Main Street Capital, which was a very sad day for everyone involved, but it was at over 2 times its NAV to price.
Well, so we sold out of that a couple weeks ago, right? 218?
218, yeah.
And you said that was a good decision based on...
It just went down. Like it was at almost 2.12 when I got out of it, and it's already at 1.86. So the price has pulled back a good amount. So I would if you're thinking about getting into Main Street Capital, which I think every income portfolio should have a Main Street Capital as a small portion of just like a steady dividend grower that's pretty reliable. I would wait till that 1.8 comes back to like 1.5. So I'd let it fall back. We'll
discuss that when we go over the actual the spreadsheet.
The next one we got out of the NEP. NEP is going to be a whoopsie daisy for the end of 2025.
Yeah. It's
an alternative energy spinoff of the electric company in Florida, NEE. But NEP, they suspended their dividends. So they had I think 13 or 14 years of dividend growth, and they literally just got rid of the dividend altogether. So there's you can hold on to it if you want to and wait for them to bring the dividend back, which I think they will do. But
sounds like a triple M situation.
But I had no desire to hold on to something that
when there's better options available.
Because again, the policy of the current administration is not going to focus too heavily on renewable energy. They're more focused on fossil fuel energy.
Drill, baby, drill.
So there's really no point in riding this the whole way down like the icon. Mm-hmm. We can just get back into it at a later time whenever they reinstate the dividend.
Learning our lesson there.
We sold out of PDI because it got too high. It was a bond fund that got too high. Now that one might be in the next month or two back into a buy point. Because
you think even with people pumping that up because everybody's running to bonds now? Mm-hmm. Interesting. Okay.
And then we got out of PTMN, which was a BDC that was severely undervalued. I just didn't like how it was going. We only held that one for a matter of maybe 6 or 7 weeks, but I didn't like what the share price was doing. The dividends, I wasn't making enough in the dividends to cover the share price loss. So I just said, F it, get rid of it. We'll put the money somewhere else. That was a quick turnaround. We made, I want to say maybe 5 or 7% is all on that one, but it still was the share price wasn't going up. What I mean by that is there's days when the market was up 3% and a lot of other BDCs were up 1%, 2%, 3%, and PTM one was down. It was down 1%. It wasn't doing what the rest of the BDCs were doing, and I didn't like where it was going. So we got out of that one, and then the final one that we sold was ULTY, which is a YieldMax option one. We made a really good amount of money in that one, but the share price is so low. I just said, I don't really want to ride this one down because the dividends were getting smaller and smaller because of the NAV decay. So there was less money for them to pay dividends out. So that's one of the problems with the YieldMaxes is as the NAV decays, the dividends are going to get smaller because they have a less pool of money in there to actually pay out dividends on.
Well, the other comment too with ULTY, that's the one that trades anything, right?
Yeah, they trade they have small cap
So
options.
That's another one that has a weird setup compared to a lot of the other YieldMaxes. So
I do believe this one might be a potential buy though, because they literally in the last month they've made this a weekly dividend payer. So it might be a potential buy. I'll have to revisit that at some point. We'll see. I don't know.
Comment for another time.
Yeah. We did add some positions this past quarter. We added AB, which I like. I like where it's going. We added AIPI, which we've discussed ad nauseum. We added BME, which is I did discuss this in, I want to say the end of the year thing. Maybe I'm wrong, but BME was one of the closed-ended funds that did really well under Trump 1.0. It's basically a science and medicine type closed-ended fund that did really well under Trump, and it's doing pretty good right now. We're already up 7 or 8%.
I think we talked about this one and where to position ourselves either for the year or the Trump episode. Probably the beginning of the year.
And then we bought into IIPR, which I had in her mom's retirement account, but then when it
dropped.
It dropped 60% or 40% or whatever it was. I picked it up for our account because it was yielding at the time like 10.28. So I was like, all right, we'll pick that up.
Yeah, I remember you saying it was too high in price for us before.
So what I basically, how I picked that one up is I sold AFCG, which I didn't have any faith in anymore, which is a cannabis REIT, and I bought IIPR, which I have a lot of faith in, which is a cannabis REIT. So I just
swap.
Just flipped it. We bought into LFGY, which is a weekly cryptocurrency. Like, that's not a cryptocurrency itself, but it's companies that dabble in cryptocurrency, like Riot and Cramforce or Salesforce, whatever it is, and
what the hell is Cramforce?
Micro something or other. Like, it holds like all the companies that have hardware and software and development on the blockchain or for the blockchain. So it's actually pretty cool. It pays out weekly. It's all right. I basically took the PTMN proceeds because I didn't like how PTMN was operating as a BDC, and I put it into SCM, which I do have a lot of faith in the SCM BDC. And then we have the THTA, which we've discussed previously, where
that's our high yield savings.
We hold our cash.
Yeah.
And then we got into YBTC as part of that experiment with the Bitcoin stuff. AB, like, I have a couple notes here. AB has grown their dividend pretty well to the tune of 11% year over year the past 5 years. So that means they're growing their dividend pretty good. It's kind of pricey-ish, but it's not pricey like IIPR. It's like $40 or $50. And what it led to the cutoff from AB was they cut their dividend. Like, it's like the sell-off was because they cut their dividend a little bit, which I'm fine with, because the way they grow their dividend when they have revenue, I'm willing to take the chance that it's going to go up and it has. All right.
So number one in the portfolio, AB.
AB, we got that. We're down a little bit in it. We got it at like I want to say $40. It's down a little bit since we got it.
Recent buy, we bought it on the 12th of February.
We literally just got a dividend for like 40 or 50 bucks in that one, but it's not on the chart because it's in
March.
It'll be the next one.
Yeah.
I like it. I think it's really good, and it has a really good yield for something that grows its dividend pretty much when they can with their revenue. If you want higher yield, I wouldn't go for this one because 8.7 is nothing crazy, but it's good enough as like a something that whenever we have cash from our YieldMaxes, we can dump it into this. I like having these 8% yielders, 7% yielders. Whenever we have cash from the YieldMaxes that we take in cash, we just dump it into these other things that are good dividend growers. Oh, there's a cat here looking at me.
Come here, Lilith.
Do you want to come on camera, or are you going to sit there and just complain? She's going to sit there and complain. Yeah, it's an investment services. That's what it is.
Okay.
It's
investment services.
Investment services. What that means is they're actually kind of like Fidelity and Schwab in that way. They have like investment services. They're not really they're not like SoFi where they're lending money out, but they just participate. Like, they have their platform and everything for investment services. When you go on their website, it literally just babbles about investment services. They don't have any like concrete examples, but whatever. I like it because it's grown their dividend pretty well, and I do think that the dividend cut was just a blip, and I do believe that it'll be back to growing its dividend in the near future. Arbor, ABR, it had a huge sell-off. It was trading in like the $14 range. It had a huge pullback into like the $11 to $12 range. What happened with Arbor was...
What even happened with Arbor? Somebody like freaked out on news, or I forget exactly.
They had an earnings report, and the earnings report came out saying that they didn't refinance some of their debt, which caused people to be concerned that like a lot of their debt would cause their revenues and their profits and everything to go down in the upcoming quarters because they didn't refinance their debt yet. So
but that was during when the interest rates were all over the place, right?
So this one here, I suspect the dividend's 43 cents a month. I think, again, I mentioned this last week, I think they're probably going to cut it to 38 cents a month, around there would be my guess. There's going to be a slight cut on their dividend just until they get their financial shit squared away again. But we've done pretty well in it. Almost 36 shares year to date, so that I like where this one's at. Even with the pullback, we're still up a lot in Arbor. If you listen to us when we said buy ABR like 2 or 3 years ago, you're sitting pretty. No reason to sell as of yet. If there is a reason, I will send out an email saying, okay, we need to get out of this one.
I don't think it was that long ago, but so what do you think the yield's going to drop down to? It's like 14.2%.
I think they're probably going to shoot for like 12.
Okay, so that's still not bad. That 12%, that's still riding gravy.
I'm not saying I think there'll be a cut, but that doesn't necessarily mean there will be a cut. Just looking at like their financials from their last earnings, like their dividend's 43 cents, and they're like the last 2 quarters they haven't made enough in revenue to cover the 43 cent dividend. It's been like 39, 36.
So profit margin red flag, always good to know.
So they're gonna probably cut that so they can actually.
And that's one of the weird ones that is paying in March instead of February.
Yeah, we got that one. It was like $170 $30 some. We got that already, but it'll be on next quarter's.
I thought you were trying to tell me that was the share price. I was like, it's 15 right now. Whoa, we got screwed.
There we got AFCG, which we sold out of. I wouldn't recommend buying this one. I mean, you can if you want, but like IIPR is better, and you're taking a yield loss, but like I don't know if the $10 buy up to price might be a little liberal. I think maybe $9. This might trade in like the $7 to $9.50, $10 range for the upcoming few quarters until they get better policy legislation and whatnot.
All right. Well, that one was paying 15.5% based on current prices, but like Tim said, that he doesn't have as much confidence in that one versus IIPR. We have made good money in it. We sold out right at the end of January. So last payout was only 106. I don't know if it's that's still pretty good.
That's what it's been. It's been consistently at that.
Why I said only just because I was looking at two other columns of zeros. But why don't you talk about IIPR next?
There's IIPR. We got it at the $72 range. I think it's at 69 right now. So the yield is actually higher than the 10.4.
Holy crap! It came down that much. That is insane. Considering we were looking at it like at the 130 range.
And we only put a couple thousand into this, and we made $70, and we got 1.1 additional shares. It does go ex-dividend soon, so if you want to get into that one, you have to get into it pretty soon. Like I think it goes ex-dividend in...
Wasn't that just on a list? It goes this week, right?
I think it's this week or next week, one of the two.
I think it's this week. Here, I'll tell you in 2 seconds.
The difference being between AFCG...
It's probably next week.
And IIPR is AFCG does in mortgage REITs for the most part. I mean, they actually hold some physical property, but they'll actually when a cannabis company buys a building or what, like when they buy a building, AFCG will like take over the mortgage basically as a mortgage REIT company, and IIPR actually owns all the buildings and they rent them out to these different cannabis companies. So I'd rather have in this case the landlord as opposed to the bank, and that's the big difference. And I think they have better. IIPR has better finances written up. They have a better management team, whereas AFCG is just kind of not that great. IIP is better, like a lot better.
All right. So.
AGNC is another mortgage REIT. It's good. Oh, hold on, the cat's vomiting.
Sorry, you'll have to restart AGNC.
Okay, the next one is AGNC, which is another mortgage REIT. This one I'm okay having investing in the bank in this one, because it's a monthly dividend payer and it yields like 14%. And if you read a lot of the articles about like the best monthly dividend investments to make, AGNC is mentioned a lot. We have not very much invested in this, but we get enough that we're getting $40 a month and we're getting 50 shares. Like
that consistently monthly, like 38, 39, 39.
It adds up a lot. So like I'm pretty sure of all the shares in AGNC, like half of them are just dividend reinvestment.
Nice. That's always nice, because that's the type of stuff you should be looking at.
That's why we mentioned this a long time ago. Like when I have an option between a really good quarterly stock and a really good dividend stock, I'm always going to take the dividend monthly payer because I'm getting additional shares each month as opposed to every 3 months. And that compound factor, the more frequency, there are charts and there's charts out there and articles written about how if you can get monthly dividend payers, it actually compounds way quicker than quarterly. Yeah, 47 share accumulation over the last year. That's a lot. Next one we discussed last week, AIPI. Like it. We only have $4,000 in AIPI and we're making $100 and something. We bought this one in the last quarter. We talked about it in the REX Share episode that we recorded a few weeks ago. This one's awesome. Like absolutely awesome. You're getting a freaking fund, a pool of AI stocks. They're already pre-vetted and it pays monthly, and they're writing covered calls on the stocks they own, as opposed to like a lot of the YieldMax stuff where you get a similar yield. It's just synthetic things. Just like I said about monthly and quarterly, if I have an option between a synthetic dividend payer that's pretty decent and a one that writes covered calls on their actual options on their actual shares, I'm going to pick the covered calls on the shares every time. Every time. And that's why they can justify the 35% yield on this thing. Yeah, they just write out of the money options. So who wouldn't want to have a pool of AI stocks plus get that payout every month? Hell yeah. It does pretty good. So we made $118. You said we only have $4,000 in this? Yeah. $118 for December, $119 for January, $114 for February. Pretty consistent. Now, one thing I will caution is like I flip the drip on and off in this one all the time, depending on share price and like sentiment of AI stocks. Like we should have more than 7 shares, but I had the drip off a month. So this one's one of the, like, it's much like some of the YieldMaxes where I say one thing, but we're doing something different in our account. Like that, what I say is basically
because it's so fluid.
When I say to leave the drip on until you recover your initial investment, that's because most people don't have the risk appetite that we do. They just want to make sure they don't lose money. And the way to make sure you're not losing money is to like not reinvest, which I will actually bring up next week. I actually ran some numbers after reading.
Oh, dude, next week's episode is going to be so good.
I read a Reddit thread about YieldMaxes, about how you can never make money in them, and they're just money sucks.
All these people are just, it's like a giant bitch fest on this Reddit thread.
So I ran some numbers, like if you reinvested the money as opposed to just taking the money in cash, along with another strategy that I'm kind of trying to fine tune before I implement it into our portfolio and then recommend it to you guys. So we'll go over that next week. It's pretty good. Speaking of YieldMax, next one's a YieldMax.
I was going to say Amazon's YieldMax is the next.
This one is really...
AMZY.
I like this one. A lot of people have nothing but negative things to say about YieldMaxes. I actually like a few of them. I really like the Amazon YieldMax. Mm-hmm. We're up, I want to say 40 or 50% in this one. That's with... you
always lose money in YieldMax.
That's even with like...
drip investing?
The drip. I've never actually had the drip off in Amazon.
Really?
I've been reinvesting the entire time.
That's really interesting. I mean, this one doesn't have as high a yield as some of the riskier ones at 42.8%. Again, at the time of...
What's going to end up happening with this one is whenever I have as many shares that I initially bought, I'm just going to pull them out. So I'm going to cut my position in half. So once this one gets up to $2,000, I'm going to take out $1,000 worth of shares. That way I have $1,000 left.
Oh, so you're using a different approach where you're just letting it drip and then you're just like...
Just one time.
Selling?
Yeah, you're ripping the Band-Aid off one time with this one.
Interesting.
But it's a monthly pair, and it does fluctuate. Obviously, you can see there from the 65, the 32, and the 44. But overall, it's been pretty good. Even when it's down a lot, like right now at $17.69, I think it's below that now.
Yeah, it's got to be below that now.
Even at that price, that was down a lot. It's normally like in the $19 to $21 range. It's a pretty good discount right now if you're thinking about wanting to make money off of Amazon, but Amazon doesn't pay a dividend. The Amazon YieldMax is an option.
It's quite nice.
There are a lot of closed-ended funds that write covered calls on Amazon stock, but I just chose to do it this way to my Amazon exposure. Next one is a coal company, I think.
ARLP.
This one here, a lot of people talk a bunch of smack on ARLP, but like again, like we've made so much money in this one. I think we're up, I want to say 70 or 80% in ARLP.
Damn.
We're up a lot. It pays out a decent amount. If you're getting 11% for, I think it's the second largest coal company in America, and coal's not going anywhere the next 4 years. This is one of those stocks, like when we bring up we'll bring up MO here in a little bit, like no matter what your personal philosophy is about the environment, this company's not going anywhere. So why not make money off it? Well,
and like we'll tell you flat out, like we're tree huggers and we still invest in oil companies and stuff like that because
our philosophy is we're going to make money and do
good things with it.
Our philosophy of change with the money that we're making from it, as opposed to like just not investing in companies.
Yeah.
I
assume some point that this stuff's going to pivot once the green energy stuff actually becomes affordable and sustainable. So I imagine just like how Coke and Pepsi have pivoted out of whatever the hell they're doing into other sectors based on demand, I imagine the oil companies and stuff are going to do very similar stuff.
They should, but
that's what I'm saying. I mean, if they're any good,
we'll see.
We'll find out for sure.
So I like that one. Really good. We've accumulated a lot of shares in this one the last year. We've held this one for... It's probably like our 5th or 6th longest one we've held.
Yeah, I know this one's been in here for a long time.
I like it. I'll continue to like it.
So it's quarterly. So it did actually pay out in February. Haha, one that did. $90.
The base dividend for this one, I think, is 70 cents, but they'll actually pay out like a supplemental dividend every now and then.
Oh, that's nice.
That's how we have a 422 for the year. We're only making, because I think this last one was just the base 70-cent dividend.
Oh, okay.
So you're still getting a consistent income source, which is 70 cents, which
plus
is
bonus checks,
which is the 10.44%. But then you're getting a supplemental income every now and then, like once a year, sometimes twice a year.
So it's like an end of year bonus. Nice.
Yeah. Next one's BITO. We discussed BITO. I mean, we rocked in BITO. BITO was like, we got into it at the right time and we made a lot of money in BITO. and I just wanted to switch it up and see if I could make the same amount of money in YBTC, and it's looking promising so far. If you're not familiar with BITO, they basically they do futures on Bitcoin. So they don't actually trade Bitcoin, they just trade futures on Bitcoin. And a lot of the cryptocurrency or the Bitcoin closed-ended funds or things that invest in crypto allegedly, they just use BITO as their options.
Which is really weird. So Tim's kind of cutting out the middleman.
So that's the reason we were in BITO, because once I saw that most of the things I was looking at actually were trading BITO options, it made no sense to not be in BITO as opposed to these other companies. But then I said, well, maybe I don't want exposure to the Bitcoin futures. I'd rather have exposure to like actual Bitcoin, and that's where the YBTC and the IBIT came in.
Yeah, exactly.
And the IBIT's not on the list because it doesn't pay a dividend.
Okay.
Just so
we do have IBIT, and then you should probably talk about YBTC here.
YBTC is they actually. So IBIT, like I mentioned up top, IBIT actually invests directly in Bitcoin. That's how their share price is determined by like how much Bitcoin they're holding, how much the price of Bitcoin's worth. What YBTC does is they trade options on IBIT. So just how I said that I don't like the whole buying closed-ended funds that do options on BITO. This is the same thing here with the YBTC. That's why I got into IBIT and YBTC, because YBTC is just IBIT. Options on IBIT, but I wanted to see if the options perform better from like a income perspective and the price appreciation perspective, or if it's just IBIT itself. And if it comes down like say May or June and like IBIT's outperforming YBTC, I will access one and dump it all into IBIT. I'm just running whichever one is doing better from it's going to be a apples to orange comparison, because IBIT doesn't have any income, but like I can actually ascertain based on if I sell the shares of YBTC, then I add back in the dividends. If it's more than IBIT, if I just sell the shares, then I'm gonna get rid of one of them. I don't know which one yet. We'll see. It's an experiment.
I feel like that experiment is stupid, because if Bitcoin takes off, obviously IBIT's gonna win out, but maybe not.
Maybe not.
Maybe not.
I don't know. And there's BME. Like I mentioned previously, under Trump, the first time this one did really well, it was up like 40 or 50%. I expect it to be up 40 or 50% this time as well. Nothing's changed in his philosophy towards the social sciences, and nothing's changed in what this company does. So it only does, like, the only bitch is it only yields like 7%. So that kind of sucks. But this one, you're going
to get price appreciation.
You're getting a lot of price appreciation with a minimal, minimal dividend for us. Like 7% is really good for other people. But that's what this one is. I think this one's going to be worth like $70 or $80.
But I think that's a strong play if it had a previous pattern when Trump was in presidency the first time. Yeah,
I like that one. I like that one a lot. So if you're like looking for a closed-ended fund to invest in under Donald Trump, even with the craziness going on, this one's held up pretty good. Next one is an oil company. It's CIVI. We brought that up last week. Her mom's in it as well. Yields 10.5%. It's
severely undervalued.
Ridiculously undervalued. If you look at any of the experts, they say this one should be in the $70 to $80 range. So you're going to get 100% appreciation.
And current price when we did this beginning of the month was $38. I'm sure that's come down since the markets have crashed the last couple of weeks.
Come down a little bit. Like this one is dependent on the price of oil, but like not as much as say if you were invested in a foreign oil company, because American oil's in the future, in the short-term future, American oil is going to be, I think, worth more than foreign oil companies. I think because we'll be able to generate so much oil and export it that this one should be fine. I don't know, because it is dependent on oil, but I think the break-even price for like when they produce oil and they transport it, I think the break-even price is at like $48, and it's currently at $66. So they're still making a profit, so the yield is still safe.
And that's like a 10.5% yield at that price. So I'm sure it's a little higher than that now.
I think this is a long-term play that I think within like 5 years, that price will double. It'll be in the $70 to $80 range. And like the dividend will be then in the 5 to 6% range, but you're still getting
payments the whole way up, and that price appreciation, which is like the best way we like to combine the value investing and dividend approach.
So
it was a perfect acquisition. Anytime you have extra money, you dump into that, don't you?
Yeah.
Yeah.
That and AB.
Because it's undervalued so much. But doesn't look like you have a ton in this if we're only getting $31 a quarter.
$2,500, $3,000, something like that.
Well, that's not too bad.
Their dividend's a variable one too. Like some quarters it's worth more. Whatever. The next one's
always fun.
The next one I'm
back to another YieldMax.
Confused about.
Very confused about. And if you guys have not actually tuned into our YouTube, we haven't talked about it on the podcast yet, like as in full-blown experiment, but we're doing an experiment with CONY. Dumped a crap ton of money into a separate account just to run another experiment. And CONY has done nothing but go down. I think we're below half of our investment capital in it at this point since December. It is not fun.
This one, we were just discussing it. I'm not concerned yet. I mean, the only concern I have with CONY is they might do a reverse stock split at some point.
Just like the TSLY one did. But if people on Reddit and crap were like, oh, if it goes to zero, it can go to zero. They absolutely can go to zero. NAV decline, blah, 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 blah. But if Tesla was doing as bad as it was doing, the TSLY one, and they did the reverse stock split, and that thing still hasn't like poof Houdini'd. So CONY's not going anywhere if it's based on, Coinbase and Bitcoin. So... And that $9.30, $9.93 current price, I think the lowest I saw when we were looking through the experiment was $7.94. So it had dropped a hell. We bought in at $17.12, I believe.
It was some high number.
Yeah, $17.12. And we borrowed money to do it with a 17% interest rate.
It's an experiment run. Like the experiment is...
If we're trying to see if we can pay back...
Sum it up is if you can borrow money to pay back the loan and then have the shares at the end of it.
It's how to get free shares without actually working for the money.
I mean, I saw like on Reddit,
OPM.
you'll see some people do it on margin, but I don't like doing things on margin. I'd rather actually not do that.
Yeah, I think margins...
If they call your margin, you have to sell shares and you're actually reducing your portfolio.
Or they automatically sell shares for you. It locks your account. It's not a pleasant experience. We've had that happen. I've had that happen. It is not fun.
So that's why so it's kind of like buying CONY on margin, but we're just using another bank loan as opposed to actual margin so that we'll still be able to pay it back even as long as the dividend stays above 26 cents. We'll be able to make our monthly payments.
So the success of the experiment is that it will work out. It'll just take a lot longer than we wanted it to initially.
I was shooting for 12 to 16 months, and it looks like it's going to be
33 as according to the data right now.
24 to 30 months.
Yeah. But that could turn around if crypto does take off. So who knows?
Because what they do is it is synthetic positions on the Coinbase stock, and Coinbase is going through a bit of a downturn right now because of the
payments have been severely cut, which sucks butt because it's preventing us from paying back, but we're still able to pay the minimum payments on the loan, and that's really all that matters.
But in our van life thing, I have $987 invested in it, so that amount we're making there is how much we're making with $987. 143,
89, and 111. December, January, February. So we made $344 in the last quarter. How much money did you say?
$987.
That's amazing.
Well, I got it at a good price.
Obviously, not like us.
So my $987 went a lot further than the $15,000 because we paid like double what I paid for it.
Yeah, and year to date, we collected $1,137. So this is the kind of stuff. Like again, we don't put a lot of stuff in tons of risk, and we just use that money and filter it back into buying probably CIVI and AB and a lot of the other ones you're talking about.
Yeah.
So that's like an advanced.
So that's one experiment we got. So with that's the second experiment. The first experiment was the IBIT and IBIT and YBTC.
Oh, now we have a third one.
Second experiment is the CONY experiment in a different account, and then the third one is I got TSLY and CRSH because TSLY is the synthetic options for the long in Tesla, and CRSH is the synthetic holdings for the short in Tesla. And my theory is that if you buy both with equal money, you're actually going to be fine. And so far, we are up a couple $100, and they both have just been crazy volatile.
Crazy volatile. But the YieldMaxes do really good on volatility. But it's freaking awesome if you can actually get rid of that principal decline, that NAV decline issue by holding both sides, the long and the short position, and then you get paid dividends on both sides. And actually, we've been kind of monitoring fiat, which is the short of the CONY, and that actually has been up a lot while CONY's been taking a beating. So I actually think
can say that within the 3 to 5 years, we're going to have. Because we currently hold NVDY, we're going to have the dips, which is the short. We currently hold CONY, and we're going to hold fiat, which is the short of CONY, and we're going to have Tesla and Tesla short too. Like within the next 3 to 5 years, we'll have all three of the shorts and the longs in those three stocks. Because what I'm seeing with the Tesla and the crash is there is a little bit of price decline. Like we're talking $100 and some dollars on $1,000 invested, so like 10%. But what we've made in dividends is like 40%. So we're up like 20 to 30%. in this.
It's like literally taking YieldMax and making sure you're not down.
So you're still down 10% in your price, the whole price.
But you're not down 50+% like we are in just CONY itself.
So had we had more money, we say we could have got another $15,000 loan. I'm pretty sure we would have actually had CONY and we would have had fiat and we would have done the
Well, I actually think we didn't actually stumble into this or have this theory, or you had this theory.
This has been in the account for a while.
I know, but we didn't actually think about applying it to that experiment with CONY because we thought crypto was going to take off. We didn't expect this pullback that it had, but it happens, and now we know for next time you always go both sides with the YieldMaxes if possible. But the TSLY one pays about 82%. We've had 123, 39, 32. I don't know what's. Oh, that was because they cut those back.
No, it was because they didn't pay. They paid 2 dividends in December.
Oh, okay.
So that's 2 dividends for some reason.
Oh boy, these things, and then Crash. 66% yield.
Again, there was 2 dividends in December for Crash. That's why it's
so 31, 13, 18. And you did say that you don't have enough shares of Crash to kind of like balance out TSLY yet, so you have the drip on that one until you get it up to a certain point. I think I remember you saying.
I'm about even right now, so starting next, I think after the next dividend, I'll be able to turn the drip off on both these.
And just let them ride to see what happens.
The same amount of shares and everything.
So we want to see with that. So
that's that one. I like it. Once I verify the experiment works, I will totally be recommending it. I just don't want to recommend it yet until I verify. I want to say at least 6 months, maybe a year's data.
Yeah, but I mean, we'll just tell you that we're doing that because we're always trying new stuff.
I'm always tinkering. Camping World is what it is.
Oh, Camping World. If you guys are familiar, you're newish. Camping World used to have a lot higher of a dividend, but they went into growth mode and dropped their dividend like 80%.
This company bought like every used RV dealership in America, and then they had no money to pay out the dividends. They're like, we're getting rid of the dividend. They slashed the dividend from like 70 cents down to like 10 cents or 5 cents or whatever it is.
Something ridiculous. Like the yield right now is like 2.5%. It's terrible.
But like what I am seeing in the earnings reports and the financials is they stopped buying everything and they're actually starting to turn around. So their revenue is up decent amount and their debt's down a decent amount. So I think this one is about to make a turnaround, and then probably the next 12 to 18 months.
Yeah. So we held this one specifically because we like to travel in the vans and we know a lot about like everybody and their mom. You go out driving in the country, like every third house has an RV in their driveway. So that's just what people do. They retire and they travel.
This one, I believe, by the end of 2026, they'll actually start increasing their dividend.
So that should be kind of cool. And if not, we'll at least get the price appreciation back to where we bought in, hopefully.
It's only down 1,000 at now.
Oh, really?
Yeah.
So that's pretty good considering how much we lost in that
38%. So like we've actually cut our losses in half.
If you go back 2 years ago, the end of 2023, that was part of our whoopsie daisies.
Yeah, this one we went from we were down like 60% and we're actually down like 37 now. So like you can see the gradual increase in the share price because of the gradual turnaround. So this one, I have high hopes in this one actually.
Yeah, I think that one's going to turn around and be interesting.
So for people that aren't in it, it's a possibility because they were growing their dividend prior to slashing their dividend because they went hyper growth. But that's whatever. Now it's starting to pour. Next one, EPR. We discussed it. I just didn't like how much it cost. That gets pulled back a lot from when we sold it at like $66 and it pulled back from 66 down to 53. I still think the only way I would get back into this one is if it dropped more to say like the $42 to $43 range.
Which it possibly could if we are slightly going into recession mode. But like you see, like that was our monthly dividend was only $21. So like you have to put a lot of money into this one to make a decent amount. Yeah, because the yield's only 6.63 at current value or beginning of the month, whatever.
So then that's basically how do you feel about like ski resorts and like
is this that entertaining one?
Yeah, it's the entertainment one with ski resorts.
And I think if we're going into recession territory, I don't imagine people are going to be discretionary spending as much because it's already cutting.
Yeah, so that one.
I think that's a risky
hold
play.
Off on that one. Here's the sister of the AIPI. It's the FEPI. This one holds like
FEPI.
It holds a bunch of tech stocks. It does exactly the same thing as AIPI. But its yield is only 26.5 as opposed to 35.5.
But it still gives you a broader tech.
We have 4,000 in this one as well, like we do in AIPI, and we're making not even $100. So we're making
92.
Significantly less with the same amount of money as we have in the AIPI.
Well, obviously the yield's lower.
But like I like them both. These are both going to be like staples of our portfolio once we move out of this condo.
And again, we like them because they're covered calls, not the synthetics, and they pay them monthly, which is another huge win. And the fact that like we're really into the tech and the AI stuff right now, so these are just two really good.
And we did a podcast on that.
Yeah, we did a podcast.
So.
Yep.
you can revisit it.
At your leisure.
Fisker Capital, it's probably my second favorite BDC right now.
12% yield.
Behind Hercules. But Hercules is getting pretty expensive.
I was going to say Fisker's looking like it's getting close to your buy up.
Yeah, Fisker, like BDCs, like for as much as people bitch about them, they're all getting, like they're all undervalued compared to their peers, the ones that were in, but they're all like to the point where it's getting almost
like you're too late to the game.
You can't buy them because...
Yeah, you're too late to the game. If you had bought when we talked about them before getting up to this point, you'd be pre-positioned and ready to roll.
We got into Fisker at like 17 something.
But now that people are talking about those and now we're seeing people talk about utilities, it's like, dude, we've been talking about these since I think like last January. So if you were late to the party, you're doing that thing where you follow the herd.
You're getting it at the wrong time.
Yeah, wrong price, wrong time. And that puts you at more risk for price.
This will have a pullback.
Price pullback.
Then you have to, like, what you have to determine when you're in that point where like a lot of people bought into it, is the yield going to cover your loss is what you're kind of getting at that point. Because this one will pull back a little bit. Is it going to pull back 12%? I doubt it. Probably pull back 6% maybe. So is the 6% yield worth it? You can get something else for 6% and then just wait for this to come out with news or like that price.
Yeah, just wait for a bad news. Earnings is
like
always,
if earnings come out and they smash it and like they increase their dividend, well then my buy up to price is going to be higher than 24. It all depends.
But still, we're in a market right now where everybody's super fearful. So even if there's like a smashing out of the park, like what was it, Amazon or something's report came out and people like panicked on one detail.
It was NVIDIA's.
Oh, it was NVIDIA's. Like it was amazing earnings report, and people like still it just plummeted after earnings. So that's the time to wait.
Which we actually hold NVIDIA in this account, but we don't include it in the chart because it don't make money from it.
Don't make money.
Don't make any money. Next one's Hercules Capital. It's just don't buy it.
Just don't buy it. It's way overvalued, and I suspect...
I mean, it's at like 18 something now because it had a bad earnings, but like even at 18 something, I would wait a tick for this one.
Yeah, I think people are just piling into that, so you could definitely get a better price on a panic sell.
But it's like one of the
staples.
When you get it at a good price, it'll become one of your staples of your income portfolio.
Now, we did not have any payouts for this because they did that February bump
We just got that one. It was like $100 and some.
Okay,
so we'll have two.
Year to date, we had 609.
So at Hercules Capital, like I've fiddled with the drip according to the share price, and like you see, we've only accumulated 14 shares. That's because for most of the year it was in like the $21, $22 range. So like
overvalued.
It was overvalued. So I just took it in cash.
Because we're always trying to maximize our money.
This one I'll probably put the drip on for the next quarter because it's at like 18 something. But that's that.
All right.
Here's another one.
Another huge whoopsie. It's been on the last two whoopsie year.
This one just keeps on.
The gift that keeps on giving. Sledgehammer blows.
I believe this one
IEP
will turn around. Looking at the financials from their earnings reports, like they're starting to get their revenues squared away, and the 50-cent dividend I think is going to be around for a while. I don't foresee a dividend increase anytime soon, but it's still yielding 20%, so there's no reason for them to increase it.
Yeah, we are not yielding that much because we got hosed. We like lost a shit ton of money on this one because we bought the shares at like 70,
72.
And it's down to like 10.
Yeah.
So we got hammered, but we rode it the whole way down. So there's no point in pulling out now, just seeing what the hell happens to it.
Well, because it's one of those, everything that could possibly go wrong went wrong within like 2 weeks.
And you did also say that you bought IEP before you really had the valuation thing dialed in. So this was a big learning lesson for us. And that's a big win even in itself.
So what happened within like a month period of time, like everything that could possibly go wrong with us went wrong with it. So the share price went from like 70 down to like 20, like within not even 5 weeks.
Yeah. And then they had to cut their dividend.
And by that point, it's like, whatever.
Had to cut their dividend. Bad news, conspiracy crap.
Because we're making a lot of money in it. So like once I actually turn the drip off on this one, we'll be making a good amount of money.
You have the drip on in this?
Oh, yeah.
I thought we had too many shares in it.
No, we're just accumulating shares now.
I thought you actually sold off because we had too much in the portfolio.
No.
Because that was the other problem. We were over diversified or under diversified.
There was a time when this was like 12%.
Over allocated.
It was 12% of our portfolio. So I didn't know what I was doing at the time.
Yeah, we no longer go above 5%.
Yeah, so 5% is my threshold now. That's why I have a sell, or like I'm selling some Hercules Capital whenever it gets to a price to take that from the 5% down to like the 4.5%.
Well, that's what it was about HTGC.
But IEP, she always asks, would you buy it now? Yeah, I would buy this one now.
He'd pile into it now if we didn't have the train wreck of the history that we had.
Yeah, I would totally be just thinking
20% dividend.
20% dividend.
This guy's track record.
That's making billions of dollars in revenue every year, and it has so many different like automotive, healthcare.
It's like a Berkshire Hathaway.
It's just a conglomerate of like so many different things that whatever.
And the guy that runs it is like the other Warren Buffett, one of the top investors.
A lot of people don't like him though. Like a lot of
doesn't
people
matter. Not a lot of people like Warren Buffett.
A lot of people like Warren Buffett because he's all like old and friendly. But Carl Icahn is
Warren Buffett's old and friendly.
That's what they think. Carl Icahn's like, I'm going to take over your company and we're going to do it this way. And that's he takes over companies and people like frown upon that. But it is what it is.
I like Icahn better than.
We discussed IIPR. It's awesome. Get into it.
All right, jump into JEPQ.
Now I actually learned something like in the last couple of weeks about this one.
Ooh, can't wait to hear.
Not this one in particular, but JEPQ is like basically it invests in NASDAQ. Familiar NASDAQ's like the tech portion of the market. So JEPQ invests. They do cover calls on tech companies.
Oh.
But they hold some of the similar ones that FEPI holds that we mentioned up above, but there's some other ones that it doesn't hold. And we've been in this one so long that we're like, dude, we're just
making mad bank.
Like everything in this is all profit. Like we've made that much money in this. That
yeah, I know we've had our full investment.
I have like $3,000 in profit just accumulated now because I've taken out the initial investment in this one long ago. Now the sister one is JEPI, the JEPI. JEPI invests in the S&P one, so it's like
tech.
No, S&P is just companies like
so that NASDAQ tech versus
so that's S&P like the difference between JEPI and JEPQ is in the NASDAQ, which generally has more volatility with a lot more growth. That's why we're in the JEPQ because what it holds I like better. But JEPI is in the S&P, those kind of companies. And it's not as much volatility, but like it doesn't have as much potential for growth because the growth happens in the tech sector. And unfortunately, the S&P is kind of like steady as she goes, whereas the tech is like, whee, it shoots up and then it shoots down. So JEPQ is much more volatile than the JEPI.
But if they're going covered calls, you would think the volatility would be better, right?
It should, and that's why we've done really well on this one.
Yeah, and Tim will argue with anybody that he likes JEPQ better than JEPI.
Yeah, I think this one's far superior to JEPI because you have more.
Do they both have about the same yield? This one's 9.47.
I think the JEPI is 8.5. I think it's like 1%.
So they're about the same, but so, dude, it is freaking pouring right now. So this one's overvalued.
It's overvalued by a little bit, but like that's because the NASDAQ itself is overvalued. It has nothing to do with this one in particular.
Is or was?
It was. So now like you could
could very well be a pickup depending what happens.
If you felt like initiating a position in this one, I would start small 25, 50 shares and then kind of like contribute here and there when you can. But I like this one. This one, like if I had to create a portfolio that had like say 6 or 7 stocks that everyone should hold for income investing, this would be one of them, along with Hercules Capital.
And quarterly or monthly dividends, 25, 22, 22. So that's all profit.
Yeah, it's all profit. So it's profit compounding on profit.
Very, very cool.
So like before I took out all the profit, we were making like 119 around there. So we took out a lot of money, but I just wanted to get my initial investment out and allocate it elsewhere.
And I assume you turned the drip on now that you have everything out.
The drip will always be on this one.
All right, so this is just drip and ride?
Yeah.
All right.
This is the one that Carmen mentioned earlier. It's royalties. It's KRP. It's a energy royalty company that it's a small cap. So like there's like there's not a lot of liquidity in it as there are, say, if you were getting into ExxonMobil or Chevron. And there's got like the difference between a royalty company and say a full-blown oil company is at some point the royalty company is going to run out of product. So this one is not going to be a buy and hold forever because at some point the oil wells that KRP actually owns are going to run out of oil and they're not doing any exploration for new oil. They're not. So that's when you're looking at royalties, you have to look at like what the expected life expectancy of whatever their royalties are on, if it's a mine or if it's oil rigs or whatever. This one, I think they said within like 15 years that their current oil rigs will start running out of oil, and then the price will shoot down, the dividend will go down, and all that fun stuff. Unless they acquire other oil, are they rigs?
I don't know if they're rigs or not. Oh, sure, call it a rig.
You know, the pumpers.
Yeah, the pumpers.
Yeah,
the things you see all over the place down south, Texas and whatnot.
Yeah, so they own a lot of those, like in the Texas area, but at some point those are actually going to run out of oil, and unless they expand into other areas and buy more oil pumper rig things
and have more land,
they're not going to have any new products, any revenue to distribute. So that's one of like that's what you have to pay attention to that when you're dealing with royalties. I know there's like a shipping royalties company where they like basically just give you royalties of what their ships make. I know there's a mineral one and a gold one where like whatever they dig out of the mine, they give you royalties on that. But
yeah, that one's really cool. So I imagine you're keeping up with this. I feel like this is the first time you've said this specifically, so that's duly noted. I imagine you will keep us abreast.
Yeah, that one
with the details on that if things change.
That's another one that we didn't get a dividend. Okay.
Yeah, so no dividends for the whole quarter, which means March.
March and May, we'll get a couple.
We've had 253 for the year for that one, and it pays 11.41%, which is pretty good. I think that's pretty good. But again, keep an eye on that thing's profit doohickeys going away in like 15 years' time-ish.
Yeah. LFGY, we mentioned previously. It's
that's one of the new ones we got beginning of
crypto,
February.
Yeah, they hold a bunch of cryptocurrency companies. Like they're not worried about the blockchain itself. They're worried about the companies that dabble on the blockchain. So I like that.
Oh, okay.
It pays, I do believe it's weekly. Yeah, it's a weekly payer. And we made...
it's one of 12 that exist on the market.
And we made $42 in February. So we got 4 payments of about $10 each. We don't have a lot in this one yet.
But still 42? That's pretty good.
I'm not certain I'm going to like it that much, so I didn't put a lot into it.
But still 42 for not putting that much in, that's not bad.
Yeah.
Yield's a little over 9%, and it's undervalued, so...
Yeah, it's undervalued.
Cool.
That Main Street got just too expensive.
Yeah, this is the one we said.
I really like it.
It was sad to part with it, but...
They pay out 25 cents a month, and then like when they have extra money left over at the end of a quarter, they'll give you a supplemental extra dividend. That's what happened in December. You see how we went from $9 up to 24. Well, that was a supplemental
so it paid a supplemental, and then it dropped back down to 8 and 8.
Yeah, it's normally we had a lot of money in this, and we were only making $10 a month. You see what I'm saying? That's why I was like,
the yield's only 5.17% when we did the numbers for this, which is kind of crap. This is a very popular stock, and you can see that it's overvalued. I imagine people are just going to keep piling into this because they do that trend thing, and Tim's like, I'm selling out. So,
well, that's like if you know anything about contrarian investing, like we mentioned this a while ago, contrarians, like when people are buying something, we don't want anything to do with it.
Nothing to do with it.
And when people are selling stuff, which they've done like market wide, we're like sitting there thinking, what can I buy? That's my mentality.
That's what Warren Buffett does.
My mentality the last 3 weeks, like other than laughing, the fact that my portfolio went from like, 111.
Dropped like 16%.
111 down to like 97.
We literally lost all of our profits for the entire last year in a 3-week period.
What can I buy? That's what like when it's shit like it is now, it's like, what can I buy? It's not, oh my God, I'm scared that the market's going to go to zero. It's like, well, everyone else is scared. What can I buy? That's a contrarian mindset. And that's something that you need to develop through time.
Yeah. If you ever expect to make money, because other people, they chase the trends up and then they're the ones losing and holding the bags. Stock investing is a zero-sum game. So you need to be aware of that, and you need to fight your instincts.
Now, like we know people, like not going to name names, but who are just opposed to being in the stock market because they think the stock market's overvalued and it should be at zero. So those people invest in other things like real estate and private precious metals and shit like that.
You can make money in anything if you know it well enough to do it. We're just not interested in the tangible stuff.
My philosophy is the stock market's never going to go to zero, and the market always goes up for the most part.
And companies are always going to need capital, and that's why they put shares on the markets for people to invest in to get to me, this is the easiest way.
So, like, for example, like if I woke up tomorrow and say Main Street was at like $30 a share, I would totally
pick it up.
I'd be like, oh my God, it went down $30 in like the last week. I'll buy it.
Yep. Because you know what it's valued at, because you look at it all the time, and everybody else would panic. So I'll be like, yes, we'll take your shares. Thank you very much.
So that's Main Street.
That's the mindset you got to get into, and that's how you make money.
I don't think it's going to be a buy anytime in 2025.
Yeah, probably not. Because that's a BDC, right?
Yeah.
Yeah. So BDCs, again, they're becoming overvalued because people are now moving into them way late in the game. We talked about that. So we'd actually.
Unfortunately, that one's going to be a 2026 or 2027 buy. Probably the next time you can get into that one at a decent price for a decent yield.
Yeah, but that won't be in our next quarterly update because we have no shares.
Yeah. So the next one is
another sin stock.
Alteria. I don't even know how to say it.
Tim's num-nums.
Num-nums.
I am going to do a video at some point where he is like swimming in piles of those things because we have piles of the boxes.
We've done exceptional in this one. I got this one, I don't know why it was at like $38.
I have no idea either. Again, this is kind of, I feel like conspiracy territory, and I know it sounds absolutely batshit crazy, but they're now finding that nicotine is actually good for health in certain conditions, long haul COVID, some of this other stuff.
That's what I've been telling her for years.
We've been talking. I know. So now there's justification because he's not chewing the tobacco. So people who thought tobacco was so wrong.
Tobacco itself is.
The pesticides.
Tobacco itself isn't terrible for you. It's how they process it to make it in cigarettes or chew.
And then the chemicals they add to it and all that other stuff. But it's like, I'm not even shitting you. I actually chew nicotine gum, nicotine Playtex.
What it does is it cleans.
It helps certain receptors in your body eject certain poisons that can only really be ejected with said chemical.
So just long story short, if we're out hiking in Arizona, I get bit by a rattlesnake, I'm going to live.
Yeah, all you have to do is chew some nicotine gum. Like
I always have nicotine in my mouth. So
and I want to test this theory now, which sounds absolutely batshit crazy. But if you guys ever follow me in the health realm, like we're crazy in the investing realm, I am crazy in the health realm. I do some crazy, crazy stuff. I just did a ridiculous cleanse beginning of January. That's why I look so poofy there for a couple episodes where I was drinking absurd amounts of weird stuff and a whole slew of vitamins.
Oh, don't stop there. Who made up the health regimen that you follow?
Oh, no, we're not going to go there. No, tell them.
Well, hold on,
let me talk about it. So it was a whole bunch of vitamins, and you sauna for 4 hours a day, and you do this literally for 3 weeks-ish. And then, to be honest, that book was written back in the 80s, mid-80s, and I actually have a sneaky suspicion that you should be doing it longer than the 3-week period of time. It literally consumes all of your energy because it's so hard on your body because your body's going into rapid healing and major detox processing. And it was funny because I'm so pop culture illiterate. Like, you tell me somebody's name and I'm like, who? And Tim's like, don't you know who this is? And I'm like, I literally have no idea. So I read through this whole book. I was like, Johnny on the spot, like all about it. And then Tim was like, who's the author? And I was like, L. Ron Hubbard. And he's like, isn't that the Scientology guy? And I was like, oh, is it?
So she followed a health regimen by the Scientology nutcase.
But I will tell you what, I want to redo it. And my mom, who did it with me, same deal. So anyway, I do crazy stuff is the whole point of this, and nicotine's part of the regimen.
Oh yeah, nicotine's good.
And I don't actually think tobacco stocks are going to go anywhere. I actually think they're going to have a resurgence once
what
this
they're doing, like if you know what
mainstream.
British Tobacco, BTI, and Altera MO, what they've done is they still produce the cigarettes, which are horrible for you. Like, don't smoke ever, terrible. And they produce the vape stuff, which is terrible for you. Don't vape. Terrible.
Almost.
But they actually have a portion of their money going to these, which are just nicotine. There's no chemicals or anything in them. It's just nicotine.
Allegedly, I feel like the cinnamon has to be some kind of chemical concoction, but who knows? I do like.
So they're
the
actually
unflavored nicotine
they're
gum.
doing the nicotine pouches now, because they know that they're like people are looking for a healthy alternative or a healthier alternative than smoking, and that's not going anywhere. In fact, I think the nicotine pouches are going to accelerate in growth, and the revenue is going to be more because the smokers are never going to stop smoking.
And the people who are discovering this nicotine thing with the long hauler
and if they stop
syndromes,
smoking, they're going to do vaping, which so like they got that covered. And if you get the weirdos, they're like, I love cinnamon, so you just give me cinnamon anything, and I'm like, that's great. So then I was like, I can get my nicotine and I can have cinnamon. Sign me up. And now I have
he doesn't stink, so
I
it's
have
the
a
win-win
big old box
all
full of
around.
empties because
they're way cheaper. My God, they're way cheaper. Plus, they give you these codes on the back, which is why we have piles of these things. But you actually have these codes you enter, and then you get like points to get stuff. And he got these amazing sunglasses, so they actually sell some pretty cool stuff.
But
there's a wallet.
Anyway, Altera, it's a dividend king. It has so many years of dividend growth, and it's like the highest yielding dividend king at 7.4%.
Now that we just gushed on like the sin stock of the century.
I love it. Like, I'm so happy that I actually found a good price to get into this because her mom has an Altera bond.
Yeah. Well, this only yields 7.41%.
That only yields 4.5%. So like the bonds back in the time when we got this, the bonds were like where everyone was pouring into, and I was like, I'm just going to buy the stock for our account because it was yielding like 8.5% at the time. And so that's where we are, and we'll probably hold this one forever.
Well, how much did we get in? Like, what was the price when we got into this? It's at like 55-ish?
Well, we got in at like 50, I want to say 48.
So our yield's a lot higher than that just because. All right, so this is another one that did not. It did pay out. My bad. I couldn't read that. It paid out in January.
We don't have a lot.
Bucks.
I didn't have a lot at the time, so I'm just disappointed by that. That's why I can't wait to get rid of the condo because I'll have more money to put into things when I find them.
We will do a live stream when we're actually investing the full proceeds of the condo equity. We're getting close, and you guys can totally join us as part of that. I want to drip that right now because that's going to be fun. Tim will have like $100,000 to put into stuff.
It's going to be a blast.
You'll get to see what we do in real time.
Next one is actually
another
turning around.
Another freaking big whoopsie daisy.
This one, like
MPW.
We have Camping World, we have Icon, we have MPW.
Those are our three big
fuck ups.
Yeah.
Of the three, this is the one I'm most bullish on.
Yeah.
they figured that like what happened was they weren't making any money to cover their bills because like they had their largest renter was foreclosing or going into bankruptcy, so they weren't getting that revenue. So they've sold off a bunch of hospitals that particular tenant was part of. And so they sold them for cash that went into like paying down their debt, and then they restructured for like some of the hospitals the tenant was part of.
Didn't they cut their dividend a little bit too? Because they had to.
Yeah, their dividends. I want to say.
Well, I imagine they had to cut it if it dropped as low as $6. I
want to say it's 10 cents or 12 cents or something like that.
Yeah,
but I believe this one within 5 years will be at least 500% higher.
Because if you actually read some of the books on dividend investing, MPW comes up as one of the like awesome stocks that's been awesome forever. So they just hit a stuff that happens in real life, like people default, shit happens.
So this one I'm super stoked about, and I love the fact that we accumulated 50 shares of this one.
And I love the fact that we kept this thing through all that downturn, and we'll get to see the turnaround at some point.
It was trading at like $3 there for a while.
Oh my god!
Like 6 months ago. So it's like it's doubled in price.
What did we buy this at?
20.
Okay, so that's how much we're down in it.
22 maybe, I don't know, somewhere around there.
So we don't have a ton of divvies because
it doesn't pay a lot.
Yeah, it dropped its yield so much, but I think you kept the drip one because you're just stocking stuff away.
For Icon, Camping World, and MPW, I just let the drip on because what's the point of turning the drip off?
Yeah. So we're just funneling that back in because when the price turns around, dude, these things could explode for.
Now the only one that I sold off I sold a little bit of Icon off.
Because it was over allocated.
Because it was over allocated, not because I don't believe in what they're doing, and not because I was scared I was going to go to zero. I could give a shit.
He was sticking to his rules.
Oh, man. My second favorite.
MSFO.
My second favorite YieldMax.
I was going to say, that's a YieldMax, right?
Yeah, that's the Microsoft YieldMax.
I get confused when they don't have the Ys on the end.
I really like this one. Again, it's undervalued right now. It should be like in the $18 to $19 range. So like this one should go up in price. It pays out monthly. Doesn't pay out a lot, so you're not getting a lot, but still a pretty good amount. And like this is another one I'm just going to pull the $1,000 out once I have like over $2,000.
Oh, okay. So you're doing the drip thing, and then you're just going to cut it in half.
Because there was three of them that I believed would succeed regardless of how fucked up the YieldMax thing was. One was Amazon, the second was Microsoft, and the third was NVIDIA.
Yeah,
I've already took the Band-Aid off of NVIDIA, and there's lump sold $1,000 worth of NVIDIA, so everything in NVDY is now profit.
Got it.
I'm going to do probably at some point in 25. I may even like just record that so you guys can see it when I just take the Band-Aid off with Amazon. But I like it. It pays out a decent amount, 36%. I guess good, but like it's now you're picking hairs because 36% in a normal stock would be outstanding, but 36% for a YieldMax is kind of But it's ran really well. Whoever's running the Microsoft one is good job. Next one is a lot like JEPQ. It's NBXG. It's a closed-ended fund that deals a lot in tech companies. And this is another one I've actually got my initial out of.
Ooh. So
I sold, I took profits throughout the time, and I actually got my initial out of NBXG. So that's why we're only making $16, $17 a month, because I took out a lot.
Took out a lot, even though this thing's paying 9.24%-ish yield.
But the reason I do that is I like my biggest problem up until like, I want to say like 6-7 months ago was how to let my runners run. Mm-hmm. What I mean by that is when you're in a company that you say it's went up 50 or 60%, do you let your winners keep running, or do you just sell it off and take your profits? Well, I decided I don't want to sell it off because it could run higher. So what I'm going to do is I'm going to take the initial out.
Yep.
That way I just don't have to pay attention to it. The drip's on. It can run to where it's going to run to. It can do what it's going to because it's all house money at that point.
Yeah. This is
the runner's running.
And that was another big aha when we lost that 700% gain in Rocket Lab.
Don't want to talk about it.
It's too soon still. Still
too soon. NAP, we've discussed it. They suspended their dividends, so there's no point.
You did that in the beginning. We don't really need to touch on that one.
And here's the third one that the third YieldMax that I love is NVDY. It's obviously it's in the NVIDIA YieldMax. Look, that's how much we're making on all profit each month.
$60.
That's crazy.
December, $88 in January, $82 in February. It pays 110-ish% in yield. Tim has said multiple times he thinks the NVIDIA one is the best of the YieldMaxes out there. It's just impeccably run.
Now I know
we've had $1,093 for the year.
I know what I just said, where I let the runners run. But
YieldMax is an exception.
There's sometimes when NVIDIA is overpriced. Like if it's like $25 or $26, I turn the drip off.
YieldMax is an exception.
Because $20 is like the anchor point of the YieldMaxes. And if it's at 25 or 26, there was a time there where CONY was like 32, 33, and the drip was totally off on that. Like I turn the drip off on these no matter if it's all profit because it's just stupid reinvesting that.
Yes, you don't want to. It's the same thing when you go to the grocery store. If something's on sale, you buy it. If it's not on sale or if the price goes up ridiculously.
So when it's trading at $25, you what is that? That's that's 25% overvalued. So why the hell would you leave the drip on, pay 25% overvalued when you could put
it in something that's undervalued? So it's like we churn our capital around, turn the drips on and off. So it's an advanced. I wouldn't even call it an advanced strategy. It's just like a way to increase or like exponentially grow your principal of your income or your portfolio through a little bit more attention. But if you don't have the time and space to do that, you don't have to do that extra attention. But we have a tiny portfolio and we're trying to grow it as fast as possible. And that's how you do that.
Well, I can tell you that this will be the first one that I dump money into this short on.
Which one?
NVIDIA. I'm going to do dips for fiat.
Yeah. Well, maybe you should be funneling their thing instead of the drip one into the dips.
All right, we'll see. PDI we discussed. It's a really well ran bond fund, but it's just overvalued.
But if you were on the emails back when November-ish, I think we sold out of like 3 different bond funds because they became overvalued.
We got out of YYY, we got out of DSU, and we got out of PDI because they were all overvalued.
Yep, all overvalued. And
I did find the one right below it, PHT, which is undervalued.
And what is so funny, the bond funds are still overvalued. And guess what everybody's talking about now that this recession is hitting? Oh my God, let's buy bonds. They're flocking to bonds. We're already out of bonds because they're overvalued. So it's fascinating, the psychology of like the average investor, how they run to where they think safety is, but they're actually...
So this one, say you wanted to get into PDI, again, you'd have to say, okay, the bonds they're holding, is it going to lose more than 13%? Because it's overvalued and people are panicking. Mm-hmm. I don't think so. I think, again, it would be 6, 7, 8%. So you'd be making 5% for the year. So you could totally get into this if you wanted to. It's just not in my price range.
Yeah.
Now, you see, I traded some of my proceeds from the DSU, the YYY, and the PDI. I put some of it into PHT, but not a lot. Because I had other stuff that I was interested in, but I took a yield loss of about 5%
from PDI.
But the price appreciation for PHT, like I assume it'll get up to the $12 to $13 range at some point, so you're getting 100%.
And that's why it's really hard to do apples to apples. So like Tim does this combination thing of like a yield plus the value, current value, undervalue type thing, and then what the actual macros and everything are happening. And that's where we pivot because again, we're value, contrarian, and income investing.
So we just tie 3 things together. I think this one we can double our initial into
in a relatively short period of time,
and
right?
we'll be collecting 8% while it's doubling. So like this again, it only has like $1,000 in it. It doesn't have a lot. That's why that dividend each month
8, 9, 6, 7.
Kind of sorry.
Yep, sorry. Even though it's 8.39, but I mean that's still a fairly low yield compared to a lot of the other ones we have. But again, he doesn't have a ton of money in here. But you're going to have a bigger growth.
If I was a, say, what are those people called? Hedge fund runners? People that run them? Oh, man. If I had like $1 trillion, holy hell.
I'd love to see what you could do with a lot of money.
What are you in that for? I'm like, because we're making a shit ton of money.
But you know what, though? You got to get creative when you don't have a ton of capital. And that's honestly, I think, why we've come up with the strategy we have. It's pretty awesome.
This is the one I got out of. I just didn't like what it was doing.
PTMN?
That was...
Every time you say the letters of this, I think of Tigger, TTFN, ta-ta for now.
So this PTFN. One here, I was making $20 a month in. We only held it for 2 months. And $20 for what I had in it was not, like, it was crap. So
if we sold this in mid-February, are we going to get a dividend in March?
No.
Okay. So we got no dividends the last quarter because it did that weird thing where it skips.
Yeah,
16%. You said you didn't like it for what reason?
I just didn't like what it was doing, like the price, like I said, like
this went straight down after we bought it.
There was days when the BDC market was up 3%, and this one was down like 0.5%.
Okay, so Tim's picking up on Spidey sense.
And there was days when, like, say the BDCs were down 0.5%, and this one was down like 2%. Like it didn't follow the pattern of the other BDCs, which to me that
means something's wrong with it. We just don't know what yet, and I imagine it'll come out in the news at some point.
Some red flags in this one that I didn't like, so I just said I'll just take. We only made like 5% on it, so I was like, whatever.
We're out.
We'll get out of it. This was QRTEP. We discussed it.
So QVCGP was QRTEP.
And we get a dividend here in this one soon.
22% yield. This is one we were talking about in my mom's portfolio that is what Tim thinks is the highest risk, just because QVC channel probably will not be around once boomers are gone.
Their financials are horrible.
Pays ridiculously high, but we get tons of money. 256 December.
Yeah, so
$990 for the year.
We're getting over $1,000 a year in this one.
What is this drip share crap? I thought you weren't dripping the shares because of the risk.
I do sometimes. Like if it's above my price, I turn the drip on.
Oh my god, you're such a hypocrite sometimes.
I know. So that one's preferred. It's supposed to be 100. Like it's a preferred share at $100 per share. So the fact you're getting it for $30 is 70% off.
QRTEP is supposed to be $100.
Yeah. So you're getting that's 65% off, 64% off plus a 22% yield is crazy.
Damn,
it's crazy. That's
why I can see why you turned the drip on.
I initially got into that one because of that. I was like, well, that's undervalued by like 70%, 80%. I forget what it was when I got into it.
But don't dump your whole freaking portfolio.
Yeah, don't do that.
Too risky.
RWAY is a BDC that I like. That I took some of the money from PTM and put it into RWAY.
Yeah.
It has it's a little bit less yield, but it actually moves in the way that the BDC market should.
And when he says less, 2%, so it's still making 14% yield.
It's a quarterly payer, though. That's one of the. So
we got $80 in December. Haven't had any since.
That we got, yeah. So like you see, that the PTM one was 2 dividends, so we got $20 per dividend payout for that one. And in RWAY, we got 1 dividend at $80. So even though that one yields more, we were actually making more in RWAY, and
because of the compound factor.
So it is what it is. Oh, she's back for more.
Uh-oh.
RYLD.
Another one you put the profits in.
Most people are familiar with QYLD, which is the NASDAQ covered call. Well, RYLD for me is the way that I do the small cap market. I just want the covered call on all the small cap stocks. This one is one of the weird ones where we got this at $27 a share, but we're actually up a lot in it because we've held it for so long, and it's crazy. Current
price is around 16. If that puts a point in your thing. 27, you said?
Yeah, we've collected so many.
So we're down that much in principal. However, because of dividend reinvesting and whatever lowered cost basis,
I've taken profits from time to time, even though it's not technically profits. I've taken some out of it because we're up a good amount. And I don't this is another one where the drip's not always on. It depends on.
Oh my god, 29 shares, even though you don't have the drip on all the time.
Yeah,
that's cray, guys.
This one's a monthly payer. It's nice.
I'm guessing this is in the love category.
Yeah, I do.
I like these numbers a lot.
I've looked at the other covered calls that deal with it, and I found a couple for the S&P that I like better than the. I forget what the hell it's called. XYLDs, the covered calls that a lot of people know. There's XYLD, which is the S&P. QYLD, which is the NASDAQ, and RYLD, which is the Russell's small cap. There's other ones out there that are better for the S&P, but I haven't found one that's as good as the RYLD for the small cap. So that's why we've been in this one for almost 5 years.
Oh, nice.
That's why we're up so much in it, because we've been in for so long that we've just.
That makes a lot of sense. Yeah, so the longer you guys are in stocks, the more you'll be making, the more things are compounding, the faster your portfolio grows. It takes about 3 years to really gain traction. Unless you have a crap ton of money to dump in.
SCM, we just got this one. We're getting our first dividend, I believe, this month in this one. Really good profit margin, really good dividend payout ratio. And it has a really good PE compared to its peers. So the metrics in this one are really good. So I understand 10.4 is not a lot in the BDC realm.
That's still a good yield.
But I like all the
and
metrics.
It's not an overpriced, so it's $15 stock. That's a good low stock too. So impeccable metrics.
So I like that one a lot. In fact, every time I do my 10x dividend chart thing,
if that thing's in the mix,
it's always on the chart for the most part. SRV is a MLP closed-ended fund. So instead of getting the K1, you get a 1099. So that's helpful if you're worried about the tax things, but it's also severely undervalued, and you're making 13% on all the best MLP companies out there.
Oh, nice. That is definitely a way to get around the K1s.
For me, when it comes to, sometimes I'll invest in individual companies, and sometimes I'll just find a closed-ended fund that encompasses all the best. And this is one of those where I really wanted to be in MLPs, because generally speaking, MLPs are 80 or 90% oil stocks. And I wanted to have a basket of all the best oil stocks, kind of like the AIPI, where I get a basket of the best artificial intelligence companies. Like the same thing with SRV, you get a basket of the best MLP oil stocks. It's undervalued. It has a good It's like
It's a really good yield.
I think it's really undervalued, but I don't. And you get a good yield.
You mean the yields drop down below that, or the price?
Yeah, and you get monthly payments, which is nice. In fact, I'd actually like to put more in this, but
money is always a problem. There's especially when everything's on sale. It's so hard. It's so hard when you don't have enough money.
It's very difficult to like pick what I want. Mm-hmm. Because I still want to stick to the 60-40, and like the SRV is a closed-ended fund, which is part of the 40. So like I have to determine where I want my 40% to be in my ETFs and my closed-ended funds and my.
I think you're crazy for sticking too diligently to that, but I probably am wrong. I tend to be overly risky.
I looked at the data. The data suggests that 60% in equities and 40% in bonds didn't work, but 60% in equities and 40% in bonds, CDs, closed-ended funds, ETFs works. So I'm going to stick to the 60-40.
You do your thing and ignore me.
THTA. That's where we hold our cash. We get like, and
we did a bullet share episode just because I wanted to preemptively do that so we could talk about THTA as a comparator. THTA hands down, like
we're getting paid every month like we did in bullet shares, and we're getting a really like twice the amount of yield,
access to treasuries
for about the same amount of volatility. Like the last 3 weeks, THTA went from like say 1917 down to like 18 something, but then if you look at the bullet shares, they were dropping from like 24 and 23 down to like 22. So they had this, it was a comparable like decline, and so I'm willing to take the 6% extra for
12% yield, 12.5% yield. Yeah, that's easy.
That's that.
So basically your cash, when it's sitting to get deployed into other investments, can be making that amount of yield just sitting. That's freaking juicy.
And we're in and out of this a lot, so like the dividends collected are going to be different all the time.
Yeah, so that one I don't even think you should have columns because that's too hard to quantify.
Trend's the newest member of I pulled all my initial investment out of it. We got this.
That was exciting.
We got this one for like 1180 or something like that, and it was all the way up to like 18 at one point. So I was pulling.
When it popped off after its earnings report.
I was pulling out like profits here and there, and then when it popped off after its earnings report, I just took the rest out. So like.
Yeah, if you've been on the podcast for a while, we're like, we had to sell shares of Trinity again because it went above the allocation value.
So this one, 177, the next time we get a dividend, it's not going to be 177. It's probably going to be like 80, but it's all profit and it's all just compounding. And
the drip went back on, I assume?
Yeah, the drip's always been on. Like, I mean, now the drip's on full time, but there was like times I would turn the drip off, turn the drip on, but like depending on the share price, like as you dabble in this more, you'll be able to ascertain when, I love that word, you'll be able to figure out, okay, if it's above this, it's overvalued. I don't want the drip on. When it's below this, like as you become more familiar with your individual portfolio, you'll actually be able to do this just as quickly as I do.
Yeah, if you immerse enough. And if not, then just follow Tim's quarterly things because he puts it all in the spreadsheet for you.
Then here's this. Oh, we already went over Tesla. That's the second part of that.
Yeah, we went over Tesla already. UAN.
UAN.
That's the fertilizer one, right?
Yeah, it's the fertilizer one that we went over in her mom's account. It's a variable dividend. Like sometimes it's 8%, sometimes it's 30%, sometimes it's 20%. Like you never know what you're getting with this one. So,
which is fun. Or when it pays out, right? It's just based on
it pays out quarterly.
Oh, so this is another one that didn't pay for the whole quarter, but it pays out in March.
We already got that one in March, and we'll probably get another one in May. So it'll be 3, 5,
2 for
8,
the next
11.
quarter. So weird. It
is weird. I really like this one. This is, like I said, this will be one that's in the portfolio forever.
Okay. Yeah, we said that because fertilizer is always going to be.
They're going to always need fertilizer to help make food for people because people can't wrap it up and not procreate.
Let's be honest, condoms suck. There has to be a better way.
So snip your tubes or like tie your tubes or whatever they do. Snip yourself. I don't know. That's what we got out of. Like it paid a lot. Like we made it a lot. The reason that we were up so high in this is because we made so much in monthly income with this one. Like you get a lot. But the dividend went from like $1 down to 90, down to 80, down to 70, down to 60. So as the price decreased, they had less capital to put into the dividend. So you were getting comparable monthly dividend payments, but there was going to come a time when you were like, what your shares weren't worth anything. I can see this one dropping all the way to like 4 or 5 before they do a reverse split.
Yeah. They obviously don't have that strategy dialed in. So it is what it is. We got out because there's better yield maxes to be in.
Yeah. So we collected a lot and we made a lot in this one. And then we got a lot of shares.
Yeah. And it's cool that we're up. So no.
Yeah. We were up like 30. I want to say 30 or 40. I forget. Like, I don't know the exact number.
I thought you said 5. Or am I confusing that with a different one?
That was a different one. That was PTM.
PTM. Okay. All right. Moving on.
So like it shouldn't be trading at what it's trading at. The only reason we got into this, I don't like the yield. The yield's trash.
5.58.
But like this one should be like 180, 190 range, and it's in the 110, 120 range. So like this is
so that's dropped a lot since.
This is we're just gonna. I dumped 1,500 into this. We'll just let it ride to where it gets, and then I'll sell it. I'll have no attachment to this one.
So this is more like a quick growth turnaround type deal, just like picking up. We're like vulturing the bad earnings report.
Yeah, so like I'll ride this one back to where its fair value is, and then we'll collect dividends on the way up, and then when I sell it, it's going to be worth a lot.
I feel like we should call that like vulture swoop or something.
Vulture. I don't know. So
it doesn't yield enough to hold it outright.
I mean, some people.
Is that a dividend grower? One of the
it grows
categories?
dividends, so that one should be good for your retirement account. But what we're doing with this portfolio, it's not.
Yeah. So that's like buy that in a retirement portfolio, turn the drip on, and then just like let the thing grow forever. This, again, we're trying to like turn over stuff. So this has a completely different strategy.
So it's like a safe way to make 6%.
Yeah.
USOY is a ETN, exchange traded notes on the USO, which is oil, like what the price of crude is. So
which we used to have that.
So this one, it yields a lot. We've made a lot.
68%. Holy hell. I did not know this made that much.
And you make a lot every month. And like I have the drip on some months, drip off some months.
This is making 203, 184, 248. That's freaking damn. That's each quarter.
Yeah.
Or each month.
Yeah, it makes a lot.
Whoa. So this is the biggest earner, I think, for the whole portfolio. For $1,500.
I've mentioned it before, like multiple times. Like,
yeah, but I don't
make a lot of money in this one.
Yeah, I don't.
Between this one and ULTY, that we were just making a shit ton of money in these two.
You say that a lot, but I don't know why the number just finally sunk in.
So this one, like, if the price is above 15, I turn the drip off. And if it drops below 15, I turn the drip on. So we've accumulated 33 shares.
That's crazy.
I have almost $1,000 of my initial investment, of which was $3,000 paid back already. So like this one, within the next probably 14 months, this will be paid back completely, and it'll just be all profit.
Damn. That's sexy. That's a van retirement, like right there. That's a paycheck retirement.
Yeah, as long as they keep paying. And YBTC we mentioned.
Yep. So YieldMax is the last stock.
It's a weekly payer, so like it's going to and it deviates, like it's variable.
As we said before, it's variable. All the YieldMaxes are variable. YMAX specifically is the index fund of the YieldMaxes.
YMAX I really like. It's probably my third or fourth favorite.
This is the one that if you do not have any YieldMax and you want to get into them, this is the first one to buy because I think it's the safest. And it pays weekly, which is really nice.
So what I'm doing now is I literally just turn the drip off to see how fast I can accumulate the money I put into it, and it's coming along pretty well. I'm at like 1,200 of the.
Is this really only saying 50% yield?
Yeah. For the current data, so I have 1,200 of my initial. I think I put 3,600. So again, I got a third of it paid back already, and this one should be paid off probably within the next year, I would imagine.
Very cool. Very cool.
So you see our totals. December we collected 2,144. January we collected 1582, and February we only collected 1276. But then there was.
What are you reading? Oh, so this is our totals for the entire portfolio.
But there was $400 missing, so that would have been 16 something.
And if you compare that to last quarters, so the first month was
1761 as opposed to 2143. So that's good. 1585 compared to 1582, it's about the same. And then the November one was a lot higher. That's the one I have to like.
2022.
I have to watch the.
In 1275 because you said November had extra payments from something.
November had extra payments and February's missing payments. So like it's not like an apples to apples comparison. So like I'm going to just monitor this. If it becomes a problem, then I'll have to find. What is that?
So we had two strategies for that. We either said that we'd have to just take it as an average and like sock up. Carry money into that month to make up for the February from November to even it out. Or what we could do is just strategically plan to be sedentary during the month of February to just not care.
And we made 5,300 for the quarter, that quarter, and we only made 5,000 that quarter. Again, $400 is missing, so we actually made more, but we just don't see it. And I'm happy with the quarterly dividends, actually.
Yeah, so that's actually about even because you said we were down, or the difference was 378.
And 378.
So if you add 378 to this,
that'd be 53.79
plus 378. 379, and last month's was 368. So we were $11. We made $11 higher.
There's a lot of
changes and movements.
So I'm pretty comfortable with where the portfolio is. So I don't foresee a lot of selling and buying going on. I mean, there's going to be some buying, but it's going to be adding positions to what we currently
as the
have.
markets keep going down, if we do go into a full-blown recession.
What we currently hold, I don't see a lot of things being sold. Like I got rid of ULTY, which I wanted to get rid of. I got rid of BITO, which I wanted to get rid of. I got rid of AFCG, which I wanted to get rid of. So I don't really see a lot of selling happening in the next quarter or probably the rest of the year.
What happened to the scarecrow?
But that's the portfolio we're making. I think we're making more than the conservative, and we are
I think we're making more than the conservative.
Plus the 378s, we're making like $700.
Okay, so we're making
like $700 more than the conservative.
And the conservative is like 173 was the value of that portfolio, and our value is like one. What did you say? One.
It's like around 100,000, like 99 something now.
Oh yeah, 99, 96, 97.
So like she has 76% more money than we do, or not now. Right now she has.
Well, I'm saying at the time of this quarterly,
70%.
You said 173.
She has like 70% more money than we have, and we're making like.
More than her. So that's the difference of how you invest. Like if you want to go uber conservative, like my mom's approach, my mom's portfolio would be the one to follow. You'll obviously need more money to hit your targets, but you will have less value of price depreciation. Whereas if you don't care, because we don't care what the hell our value of our portfolio really is, it's more about the payouts because we want to be able to live off the payouts.
It's all about the payouts.
It's all about the payouts. It really is all about the payouts.
The whole point, like I think I was watching a video and he said it's the no withdrawal retirement plan. I like how he worded that.
I like that too. No withdrawal.
That was
no
Brett
sell
Owens. If you remember when I was talking about the contrarian outlook, Brett Owens said that in his last webinar. He said we have a no withdrawal retirement, and I like that should be everyone's objective, to not actually have to withdraw money from your retirement, but still be able to live off of your income that your portfolio.
I don't know if withdrawal is the right word because you're still technically withdrawing out of the portfolio. It would literally be the no sell stock. No stock sale.
I don't know.
No cash out.
You tell us what it should be named.
Yeah, we'll have to come up with a better name for that. But
and we're going like we do. I do plan on doing a live stream. She wants to do a live stream when I buy stuff with the lump sum. That'll be fun. But then
but I gotta get the portfolio or the condo done, which we are working. The reason my hood is up is because I have epoxy in my hair. So I'm probably gonna have to cut my hair off.
That was a shit show.
Oh my god. Yeah, I caused a huge mess last night.
Big boo boo.
Epoxy pouring all over the place. Whoopsie.
Big boo boo. But that next week's gonna be YieldMax and how I would invest in them compared to how Red's investing in them, and you see that like they're talking.
Are we still gonna do one on recession? The recession commentary? I think we should do something. I don't know if you've had time to look into that. Like, are we actually? Like, what's the prediction for the recession thing versus like history, yada yada?
All the indexes are in a correction right now, so it's possible that we could go into a recession.
Well, I think he said I think we just did like a TikTok video or something. You said it's possible that we could stop at a 7 to 8% decline because this is what happened the first time Trump was president. Or it could literally recorrect and just keep going down as a recession. And I think if that does, I think it very well could be like depression level type pullback because we have been overdue for a correction for a while, and the level of panic and fear has been at an all-time.
What are you doing?
But if we are actually in a correction, I can't say that I'd be upset from the CONY experiment standpoint.
But that next week will be the YieldMax, and I'll how it's.
That's going to be a really interesting experiment. So you're going to want to tune in for that because that's like another way to reduce risk in YieldMax.
I think.
Plus the history aspect, it's going to be ShamWow. So all them Reddit threaders can.
And we probably will do something about a recession at some point because I do foresee a recession at some point in the next year.
Bye, guys.